Most people think a pullback in silver means the move is over. I usually see the opposite. When gold starts warning me that the money system is under pressure, silver often stays quiet just long enough to fool people. Then, when the crowd finally understands what gold was saying, silver can move faster than gold. That is why the sharp drop that scares people now can be the setup for what comes next. If you like hearing markets through cycles instead of headlines, keep this channel close, because what I am about to lay out is not the kind of thing you catch by watching price for 5 minutes. I have spent most of my life studying how debt, money, politics, and human behavior move together. What I have learned is that markets do not move in one clean line. They move in phases. Gold usually leads when trust begins to crack. Silver usually lags at first because people are not sure if they are looking at a safe haven move or just another commodity trade. That confusion is exactly where the opportunity is born. The easy story says gold is the serious metal and silver is the wild cousin. There is some truth in that. Gold is held by central banks. Gold sits in reserves. Gold is what countries reach for when they want money that is no one else's liability. That means it gets the first wave of institutional trust when debt levels rise, politics turn ugly, and paper promises start to look weaker. I have said many times that I do not think of gold as just a metal. I think of it as money, not money in the everyday digital sense, but money in the old sense. It cannot be printed. It does not depend on someone else paying you back. It does not need a politician, a central banker, or a banking system to keep its nature intact. That is why gold tends to move first in late cycle conditions. And those late cycle conditions are not hard to see. Central banks have bought more than 1,000 tons of gold in each of the last 3 years. That is far above the roughly 400 to 500 tons a year they averaged in the prior decade. In one recent survey, 95% of central banks said they expect global gold reserves to rise, and 73% said they expect the share of US dollars in reserves to fall over the next 5 years. I pay attention when the people closest to the plumbing of the system start shifting that way. That move into gold tells me something bigger than gold is bullish. It tells me trust is changing shape. Countries are looking at debt, sanctions, deficits, and reserve risk, and they are quietly saying, I want a little less exposure to promises and a little more exposure to something final. Gold is the first answer to that problem. But it is not always the only answer. This is where most people stop thinking. They see gold rise, they see silver pull back, and they assume silver is weak. I think that is often too shallow. Silver is not just a smaller gold. It is a monetary metal with an industrial heartbeat. That makes it more volatile. Volatile just means it moves around more. That scares people. But in the right part of the cycle, that same trait is exactly why silver can outrun gold. Here is the mechanism in simple terms. Gold moves first because it is the cleanest hedge against broken trust in money and debt. Silver moves later because investors need more proof. They need to believe the move is real, not just a panic bid. Once they believe it, they often look at silver and think gold already ran, silver has not caught up, and silver's market is much smaller. When money flows into a smaller market, price can move a lot faster. If this way of thinking sharpens how you look at risk, stay with me, because the gold move is only the first chapter. The silver move, when it comes, is usually the chapter people remember. I do not use the gold-silver ratio as a magic number because markets are not ruled by magic. The ratio simply shows how many ounces of silver it takes to buy 1 ounce of gold. It stretches when fear is one-sided. It snaps back when the market broadens. In 2020, during the COVID panic, that ratio blew out above 123. That meant gold had become extremely expensive relative to silver. Buyers who understood the stretch and acted on it saw silver more than double off that low. I have seen this movie before. In early 1980, after inflation and distrust had been building for years, the ratio fell to about 17. That was not normal. It was the mark of a late emotional move where silver ran much harder than gold. I am not saying history repeats in the same shape. I am saying the pattern matters. Gold often leads the warning. Silver often leads the scramble once enough people accept the warning. That is why a pullback matters so much. A pullback clears weak hands. Weak hands are buyers who like the story only while price was going up. They have no plan. They have no tolerance for pain. They buy excitement and sell discomfort. When they get shaken out, the market often becomes stronger because the people left are the ones who understand what they own and why they own it. Now, I want to make something very clear. I do not think silver is a better store of value than gold. Gold still has the deeper monetary role. Gold is what I would want as the foundation if I were protecting wealth against a debt-driven world. I have said before that for many investors, holding something like 10 to 15% in gold makes sense as a strategic allocation. Strategic means you own it because the system is fragile, not because you are guessing next week's price. Silver is different. Silver is where I look when I think the monetary move in gold is likely to spill over into a broader move in hard assets. It is not the anchor, it is the accelerator, and that distinction is everything. If you confuse an accelerator for an anchor, you will size it wrong, hold it wrong, and panic at the wrong time. The reason silver has this extra torque is not only that it is smaller, it is also that silver sits in two worlds at once. It has monetary demand because people buy it when they want something tangible, and it has industrial demand because it is used in electronics, solar panels, vehicles, and a lot of modern equipment. That mix makes silver messy in the short run and powerful in the right macro setup. The numbers tell the story. In 2024, global silver demand was about 1.164 billion ounces. Supply was about 1.015 billion ounces. That left a market deficit of about 148.9 million ounces. A deficit means more silver was demanded than newly supplied. Industrial demand alone hit a record 680.5 million ounces. Solar demand was about 197.6 million ounces. Mine supply was roughly 819.7 million ounces. When I see repeated deficits like that, I do not dismiss them. But I also do not oversimplify them. People hear deficit and assume price must explode right away. Markets do not work that neatly. The silver market still has above ground stocks. That means silver already exists in bars, coins, vaults, funds, and products. Those inventories can cushion the shortage for a while. That is one reason silver did not fully express its tight fundamentals right away. There was enough silver around to delay the squeeze. Ask yourself this: if an asset has strong structural demand, repeated deficits, and a market far smaller than gold, what happens when capital finally stops ignoring it? Another reason silver can lag at first is institutional behavior. Large macro funds and sovereign players are usually more comfortable buying gold. Gold has greater depth. Depth means a bigger market with more liquidity, so large buyers can move in without disturbing price as much. Silver is thinner. Thinner means it can move more sharply and feel less comfortable to institutions at the start. So gold gets the first institutional wave, then something changes. Gold climbs long enough that people stop arguing with it. The move becomes undeniable. At that point, investors start looking for what has not fully adjusted yet. Silver becomes the obvious candidate. It still carries monetary appeal, but it also has a catch-up trade built into it. That is often when the ratio starts to compress and silver begins to outrun gold. I want to bring this down to a human level because all of this only matters if you can feel how people actually behave. I know the mental trap. I watch gold hit new highs and I think maybe I am late. Then I look at silver and I think maybe this is the cheaper door into the same house. That thought is powerful because it carries both fear and hope. Fear of missing the move, hope of finding value. That is why silver attracts a different kind of buyer in the second phase. Gold buyers often want protection. Silver buyers often want protection plus upside. That extra desire for upside is what can make silver move harder once the emotional temperature rises. It pulls in the cautious buyer, the value buyer, and the speculator at the same time. When three different motives hit one smaller market, the price can jump quickly. If you have ever felt torn between protecting wealth and trying to grow it, then you already understand the pull silver has in this part of the cycle. That tension is exactly where silver gets its energy. Now let me deal with the biggest objection because it is a fair one. People say silver is too industrial to outperform if the economy weakens. They are right to worry about that. If growth falls hard, factories slow, and demand for manufactured goods drops, silver can get hit. That is one reason silver is more volatile than gold. Gold can do better in the first shock because it is cleaner as a fear asset, but that objection misses where we are in the larger sequence. In a debt-heavy system, a downturn rarely ends with leaders saying, "Fine, we will accept pain and do nothing." They usually cut rates, run deficits, support banks, support markets, and create more money and credit. That response helps gold first. Then once people see the response is large enough, silver can benefit from both the monetary side and the recovery side. In other words, silver often suffers in the fear spike and then outruns in the policy response. This matters more today because the debt side of the system is no longer a side issue. U.S. interest costs reached about $970 billion in 2025. They are projected to hit $1 trillion in 2026 and around 3.2% of GDP. GDP is the size of the economy. So when interest alone starts taking up that much room, I do not think of it as a normal budget line. I think of it as pressure in the machine. Pressure like that usually leads to more financial repression, more currency weakness over time, and more need for hard assets. Financial repression is a dry term for a simple thing. It means the system tries to keep rates low relative to inflation, so debt becomes easier to carry. That helps debtors and hurts savers. If your cash earns less than prices rise, you are losing purchasing power quietly. Gold has always been one of the cleanest answers to that. Silver becomes interesting when the market starts asking for more than safety. It starts asking for torque. I also look at the global political layer. We are in a world with more sanctions, more blocks, more supply chain tension, and more reserve diversification. Gold is the official answer to that shift. Central banks are not about to replace gold with silver in their vaults, but that is not the point. The point is that once gold validates the distrust, private capital starts looking for the next expression of that same distrust. Silver is often one of the first places it goes. And there is another force under the surface. The world wants more electrification, more grid investment, more data centers, more AI hardware, and more solar build-out. Those trends are not smooth month to month, but the structural direction is clear. The Silver Institute noted that industrial demand should keep outperforming global GDP over time, helped by solar, battery vehicles, and the build-out of power-hungry data centers. I pay attention when a metal is both money-sensitive and future economy sensitive. Do you know which assets in your world depend on cheap money staying cheap, and which assets can survive when trust in money starts to break? That question matters more than people think. I want to say something about history because history is where I go when the present gets noisy. In the 1970s, gold did not move because people suddenly loved shiny things. It moved because inflation, oil shocks, weak confidence, and policy stress changed the way people saw money. Silver eventually moved too, and when it did, it ran much harder. That did not make silver safer. It made silver more explosive. Late cycle upside and late cycle danger often travel together. That is why I never want people to hear silver could outrun gold and translate it into silver is easy. It is not easy. Silver can drop hard. It can scare you out. It can look broken right before it wakes up. That is what volatile assets do. If you own silver without understanding that, you will make emotional decisions. And emotional decisions are where investors usually donate money to the market. I learned a long time ago that the market's job is not to make me comfortable. Its job is to reveal who understands the cycle and who is just reacting. Pullbacks are part of that test. They force me to separate price from thesis. If the thesis is debt pressure, currency pressure, reserve diversification, and tight structural demand, then a pullback is not automatically a reason to run. Sometimes it is just the market demanding conviction. Let me lay out what I think could happen next, because there is never only one path. In the first path, growth slows but does not break. Inflation stays sticky enough that real rates remain weak. Real rates are interest rates after inflation. In that setup, gold stays firm because money is still being diluted, and silver can outrun because investors start reaching for the smaller, lagging metal with stronger cyclical upside. In the second path, we get a harder slowdown. Risk assets fall. Silver may get hit first because the market worries about industrial demand. Gold likely holds up better in that first wave, but then policymakers respond with cuts, liquidity, and more support. If that response is large, silver can come back faster and stronger because it has already been discounted, and now it benefits from the same monetary impulse that helped gold. In the third path, geopolitical stress gets worse while economic activity stays uneven. That could keep gold in the lead for longer because official buyers and large institutions prefer it. Silver might lag in that case for a while. But even there, if gold keeps proving the case and the ratio stays stretched, silver can still wake up later. The timing changes, the logic does not. There is also a less favorable path, and I always want to state it plainly. If we get a real industrial slump without enough monetary response, or if inflation collapses and real rates stay high, gold could remain the better asset and silver could keep lagging. I do not pretend every cycle must end in silver glory. Good investing is not about certainty. It is about weighing probabilities and understanding what would change my mind. If you want more of this kind of slow thinking in a fast world, keep returning here. Most mistakes in markets are not made because people lack information. They are made because people lack a framework. So what do I do with all of this? I start with the hierarchy: gold first, silver second. Gold is my core hedge against a debt and money problem. Silver is a more tactical expression when I think the move in hard assets is broadening and the ratio has stretched too far. I do not need silver to replace gold. I need it to do what smaller, more volatile markets do when a macro signal becomes widely believed. I also size them differently in my mind. Gold is something I can hold for strategic reasons. Silver is something I must respect for tactical reasons. Tactical means I care more about timing, sizing, and the path it may take. If I treat silver like gold, I will almost surely get surprised. If I treat silver like a chaotic side bet, I will likely miss the structural case. The right view sits in between. For people thinking practically, I would not chase silver after a vertical spike, and I would not wait for perfect calm before touching it either. I would think in layers. If I believed the macro case was intact, I would build exposure in pieces. Not because I know the exact bottom, but because I know I do not. I have said before that the bigger risk is often not being in the position I want, rather than entering it at a price that later looks imperfect. That matters emotionally. Buying all at once can make a good idea feel unbearable if price drops the next week. Buying in stages gives me room to be wrong on timing without being wrong on direction. It also helps me avoid turning a strategic idea into a short-term stress event. Markets are hard enough without making every decision all or nothing. And I would keep one final distinction very clear in my mind. Gold is the asset I want when trust breaks. Silver is the asset I want when the market begins to realize how deep that break may go. Gold is the first alarm. Silver is often the louder second alarm. That is why silver can pull back hard and still be the better runner later. So when I hear people say silver is weak because it corrected, I do not rush to agree. I ask a better question. Did anything important change in the debt cycle, the policy pressure, the reserve shift, or the structural demand picture? If the answer is no, then I may not be looking at weakness at all. I may be looking at the market resetting before the next phase. That is the deeper point. Most people stare at the candle. I watch the cycle. Most people ask which metal looks stronger today. I ask which one is leading and which one is loading. Gold has a bigger monetary role. Silver has a smaller market and a second demand engine. When those two facts line up after a pullback, silver does not need to be safer than gold to outrun it. It only needs the crowd to notice what gold has already been saying. In the end, I do not buy the idea that silver must always follow gold in a polite, measured way. In these debt-heavy, trust-shifting periods, markets do not move politely. They move in bursts. They move when psychology catches up to structure. They move when something people ignored becomes impossible to ignore. That is why I keep watching silver after pullbacks, not because it is calm, but because it is not. Gold tells me when the system is under strain. Silver tells me when that strain is spreading through the crowd. And when those two messages arrive in sequence, the fastest move is usually not the first one people see, but the second one they almost missed.